Let's review chapters 9 and 11. So question number 1 says, FAR company elects to use the percentage of sales basis in 2019 to record bad debt expense. It estimates that 2% of net sales will be uncollectible. Sales revenue for 2019 is $800,000. Sales returns and allowances are $40,000. And allowance for doubtful accounts has a credit balance of $9,000. So we need to prepare the adjusting entry to record the bad debt expense, to record the amount that we expect to be uncollectible. So we have all the information over on the left side. But we are figuring out this 2% of net sales. Well, first we need to figure out our net sales. So that's going to be our sales revenue minus our sales returns and allowances. So $800,000 minus $40,000, and you find out that your net sales are $760,000. So we say 2% of that will become uncollectible. Well, 2% of $760,000, we multiply that by 0.02, and we find that 2% of our net sales is $15,200. So now we're ready for the journal entry. What we'll do is we'll debit our bad debt expense and we will credit our allowance for doubtful accounts. Whether we're using the percentage of sales basis or the percentage of receivables basis, this will be the framework of your journal entry. What changes is how you get your numbers and what your numbers will be. So when we are working on percentage of sales, we don't worry about what the allowance for doubtful accounts has. So we totally disregard that $9,000 credit balance. We're just worried about the 2% of net sales. So we will debit bad debt expense $15,200 and we will credit allowance for doubtful accounts $15,200. Now question number 2. Kingston Company uses the percentage of receivables basis to record bad debt expense. It estimates that 1% of accounts receivable will be uncollectible. So they don't think they're going to get that money back. Accounts receivable are $420,000 at the end of the year, and allowance for doubtful accounts has a credit balance of $1,500. We need to prepare the adjusting entry to record the bad debt expense for the year. So we have our information again over on the left, and we need to figure out 1% of our accounts receivable. So 1% of accounts receivable will be your $420,000 balance times 0.01. So 1% of your accounts receivable is $4,200. Now, we were told that allowance for doubtful accounts had a credit balance of $1,500. So we make a T account here for our allowance for doubtful accounts. And we put the $1,500 over on the credit side, and we want that account to end up with $4,200 as its balance. That's that 1% of our accounts receivable. So our entry is for this number that's going to go in this red circle. What are we going to have to credit to allowance for doubtful accounts to take it from $1,500 to $4,200 on the credit side? Well, we subtract those two amounts, and we know that we need to credit allowance for doubtful accounts $2,700. So we will debit our bad debt expense again and credit our allowance for doubtful accounts, and the number that we're going to use in this adjusting entry is $2,700, because we are adjusting our allowance for doubtful accounts from its $1,500 balance to its new $4,200 balance. And to do that, we needed to credit the account $2,700. So now let's change it up a bit. Last time we had a credit balance of $1,500. This time, allowance for doubtful accounts has a debit balance of $800. Everything else is still the same. Accounts receivables, $420,000. We're still estimating 1% of that to be uncollectible. But the change in the balance for your allowance for doubtful accounts is going to have an impact here. So, we have all of our information over on the left. We know that 1% of our accounts receivable, that's still $4,200. That didn't change. What changed is this T account for our allowance for doubtful accounts. We now start off with a debit balance of $800. We want to end with a credit balance of $4,200. So we're going to have to credit something in this adjusting entry. And to figure that out, what we're going to do is we're going to take the $4,200 that we want to end up with and add that $800, because we need to credit $5,000 in our allowance for doubtful accounts to go from a debit balance of $800 all the way to a credit balance of $4,200. So now we will journalize our adjusting entry. Once again, it's a debit to bad debt expense and a credit to allowance for doubtful accounts. Our number is our $5,000. It's the amount to go from the $800 debit balance to the $4,200 credit balance. We needed to have that $5,000 credit for allowance for doubtful accounts. Now question number 3. So we need to record the following transactions. On March 1st, Jerome LLC borrows $10,000 on a 6% 3-month note. Then, on May 31st, Jerome LLC is going to be paying the principal and the interest that's due. So, our first entry on March 1st. Jerome LLC borrows $10,000 on a 3-month note. Well, so they're borrowing cash, so we need to debit our cash to make our cash account increase. And they're borrowing this money on a note, so we need to make our notes payable increase with this credit. So we will debit cash $10,000 because that's the amount of money that we are borrowing here. So our cash is increasing by $10,000. And then our notes payable, that's also increasing by $10,000 because that's the principal that we owe on this note. Now, the end of May rolls around and Jerome LLC is going to pay the principal and the interest that's due. So, if they're paying the principal, that means that their notes payable has to decrease because now they don't owe as much anymore. They're paying off some interest, so we need to record an interest expense. And how are they going to pay off this note? Well, they're going to be using cash. So now let's figure out our numbers. Notes payable, that's going to be just the face value of that note. So the notes payable has to decrease by the $10,000 because they're paying off all of the principal on this note. Interest expense, we have to calculate this one. So that's your principal times your rate times your time. So our principal, that was the $10,000. Our rate, that's the 6% interest rate that we were told on the last slide, times 3/12 because it's a 3-month note and 3 months have passed. So you multiply that out and you get $150 for your interest expense. So we'll toss that in for interest expense. Now, cash, Well, we're paying the principal and interest. The principal's $10,000, the interest is $150. So principal and interest is $10,150. We just add those two together. Because remember, we need our debits and credits to equal. Now question number 4. On December 1st, Bruni Company introduces a new product that includes a 1-year warranty on parts. In December, 1,000 units are sold. Management believes that 5% of the units will be defective and that the average warranty costs will be $90 per unit. Prepare the adjusting entry at December 31st to accrue the estimated warranty costs, and then prepare the entry to record the costs incurred in honoring 15 warranty claims. So Bruni Company has this product, and they told their customers if they buy it, there's a 1-year warranty. Well, a company has to be able to plan for the costs associated with that warranty. So that's what we're doing here in this question. So there's a couple journal entries and a few simple calculations involved when we're dealing with a warranty problem like this one. So first we need to estimate our warranty costs. So we have 1,000 units sold. We think 5% of them will be defective, and the average warranty is going to cost $90. So let's first figure out how many defective units we think there will be. So that's going to be our 1,000 units times our 5% times 0.05. And if you take 1,000 times your 5%, you end up with 50 units. So we think that 50 of these units will end up being defective. We've sold 1,000, 5% will be bad, that's 50. So what are our estimated warranty costs? Well, we think 50 units will be defective, and each of those units, on average, will cost us $90. So 50 times 90, and you'll see that your estimated warranty costs are $4,500. So we can now prepare the adjusting entry to accrue the estimated warranty costs. The entry is going to look like this. We need to debit our warranty expense, and then we will credit warranty liability. So whenever you're estimating your warranty costs, this is what your journal entry is going to be looking like. The number that we include in this entry, well, we calculated it. That's our 4,500. Let's look at it from the point of view of the warranty liability. We estimated that we're going to have to pay out $4,500 in warranties. Well, another way to look at that is that we are liable for $4,500 worth of warranty costs. So we need to make that liability increase. We also want to make our expense increase because we sold these units in this year. So we have to record that expense for this year. Now we need to figure out the journal entry for when we honor warranty claims. So we're honoring 15 warranty claims, and well, we still think that the average warranty cost is $90, so we'll use that information. So the cost to honor these claims, that's going to be 15, the 15 warranty claims, times $90 per claim, and we think that the cost to honor these claims will be $1,350. So your journal entry, our liability is going to be debited. So warranty liability is debited because we're no longer liable for those claims anymore. And we will credit an account called repair parts. These warranty claims come in and we have to fix the product, right? So we're going to be using repair parts. So our repair parts will be decreasing here with this credit. And we use the number 1,350, which we get from the number of claims times the average warranty cost. So let's take a look at a T account for warranty liability. We initially credited $4,500 to our warranty liability. Then we debited $1,350. So after honoring these warranty claims, we would still have $3,150 in our warranty liability account. So we are still thinking that we will have to be liable for $3,000 worth of warranties. Now let's take a look at question 5. So question 5 deals with FICA taxes, gross earnings, net pay, the payroll topics that you covered in chapter 11. So Beth Corbin's regular hourly wage is $16. And she receives an hourly rate of $24 for work in excess of 40 hours. So up to 40 hours a week, Beth is making $16 an hour. If she works overtime during that week, she gets $24 per hour. During a January pay period, Beth worked 45 hours. So she worked 5 hours of overtime. Her federal income tax withholding is $95. She has no voluntary deductions, and the FICA tax rate is 7.65%. So remember, FICA is made up of Medicare, which is 1.45%, and Social Security, which is 6.2%. So that's where they get that 7.65% from. So we need to compute Beth Corbin's gross earnings and net pay for the period. And then we need to make some journal entries. We need to prepare the journal entries for her pay for the period and the payment of her wages. Let's first work on gross earnings. So we have this table here. It told us that she worked 45 hours. Well, let's split that up between the 40 regular hours and then the 5 hours of overtime. Her regular pay is $16 an hour, and her overtime pay is $24. So we'll write that down in our chart. So now we have our number of hours that Beth worked and her hourly wage. So if she worked 40 hours and got paid $16 an hour, we will multiply those two numbers together to get our totals. So 40 times 16 is 640. And then her 5 hours of overtime at $24 an hour got her an extra $120. So the gross earnings are the total amount that an employee earns. Right? So the gross earnings in this case, we want to add up the 640 and the $120 to get a total of $760. So Beth Corbin's gross earnings are $760. Now we need to figure out the net pay. Well, we have the equation there for net pay. It's your gross earnings, which we just found, minus our deductions. So deductions are things like taxes, voluntary deductions, right? So we need to figure out what her deductions were for this pay period. Well, they told us that the federal income tax withholding was $95. So that's part of our deductions. Then it says she has no voluntary deductions, so we don't have to figure out any of those. But then the FICA tax rate is 7.65%. So we need to figure out our FICA tax. To do that, we take our gross earnings, the 760, and that's what we're taxing at 7.65%. So 760 times 0.0765 gets you $58.14. So the FICA taxes in this pay period for Beth Corbin were $58.14. So the total deductions will be those two added together. So if we add together the federal income tax and the FICA tax, the 95 plus the 58.14, we see that the total deductions are $153.14. So now we can figure out our net pay. Again, our net pay is going to be our gross earnings minus our deductions. So our gross earnings are $760. Our deductions, we just found those, $153.14. So the net pay is $606.86. So the next time you get a pay stub from your job, take a look on that pay stub. It'll mention your gross earnings and then your net pay. Your net pay is the amount that your paycheck is actually for. So Beth Corbin's going to be able to put a paycheck in her bank account of $606. The gross earnings, that's the total amount that she earned in that pay period. That doesn't mean that's the total amount she's going to actually receive, right? So the net pay is the amount of money that she actually gets. So now let's take a look at these journal entries. So we first need the journal entry for the pay for the period. So it's going to look like this. We're going to debit our salaries and wages expense. And then we credit all of our taxes and deductions payable. So we will credit federal income taxes payable, FICA taxes payable, and then we credit salaries and wages payable. Well, we know our federal income tax and our FICA tax number. We already figured those out on the last slide, right? Federal income taxes are $95. FICA taxes are $58.14. But now we need to figure out what goes into our payable and what goes into our expense for salaries and wages. Well, your payable is going to be your net pay, right? Payable. So salaries and wages payable is your net pay of $606.86. Well, if you add up those three, you get $760. Where have we seen $760 before? $760 was your gross earnings. So earnings and expense both start with E, right? So there's a few different ways that you can remember that. Your net pay goes into your payable, or your earnings go with your expense. Now the journal entry for the payment of Beth's wages. Well, this is when us as the company, we are now writing her paycheck. So our salaries and wages payable will be decreasing because we won't have to pay her as much anymore. And how are we going to pay her wages? Well, we're going to use cash, right? Checks are considered the same as cash. So how do we figure out our number? Well, we look up at our last entry. And in our last entry, we credited salaries and wages payable for $606. Well, let's throw that now into this entry. So we are now decreasing our salaries and wages payable for $606.86. Right? This is what we said was the amount that would be on the paycheck. So the amount of cash that we are giving to Beth is $606. So that's why it goes in this entry.